welcome to TheoTrade. This is Don Kaufman. It's March 13th, 2019, and you are watching the TheoTrade evening video. Moments after today's cash close, the S&Ps are up right now, a blistering 21. The important point to take away from this, though, is that we tag the oh-so-important 2811 gravity point. Now, I got to tell you, 2811, for those of you that have been kind of tuning into TheoTrade for quite some time, we've obviously delineated some very specific gravity points here, and I must give it to the 2811. You know, that's the once, twice, third time, fourth time, fifth time. You know, maybe the fifth time's the charm. That's actually a little bit of what we're going to be discussing here kind of momentarily. You know, to kind of take this down to intraday trade, I don't want to dissect intraday trade all that much. We came right to the 2811. Okay, which again is our gravity point. We sat literally on it. I mean, I'm taking you right now into a highly granular kind of intraday, 1 day, 1 minute chart. Is that granular enough for you? You literally came to 2811, sat on it, okay, and then exploded off that 2811 higher inside of trade. Now, I'm going to show you something about bonds here in a moment, okay, on a much broader time scale, but I also want to show you on an intraday basis that something that really bothered me today is that the S&Ps kind of burst back to the upside. Okay, there was little to no movement whatsoever inside of the bond market, and this is the bonds. I mean, these things were like flatlining throughout the course of the session, and it got me looking again at a much broader time frame. When I say a broader time frame, I zoomed out the time frame here, went back to like the 9 month. And you start to recognize between bonds and equities, something has got to give. Now, I'm going to come back to that here momentarily, okay? Just remind you that, again, between bonds and equities, something has got to give. Before I go any further, one thing I want to mention about the S&P is, as I said, it's kind of the fifth time might be the charm here at the 2811. But nevertheless, we still have a gravity point above this, okay, of 2842. Are we going to hit it? Well, again, I'd be surprised to see that this particular week, because if we take a look over at the SPX, all right, which is the mother of all products in the SPX, people, first of all, we are way outside the expected move. This is the expected move for the week. Again, kind of the week kicking off right here at the central spot of right around 27. We'll call it like 43. That's about where the week started. Okay, what have you done this week? Exploded right back to the upside. Ironically, we are pretty much where we kicked off the previous week of trade. Nevertheless, there's still an extraordinarily high probability that we pull back inside. Again, back inside of the SPX expected move. With that, when I talk about the SPX and the expected move, you know, we sometimes lay butterflies on the edge of this expected move. The edge of the expected move is 2786. Okay, so what I've done is I've actually gone out there and I've positioned myself with a Friday. By the way, this is a Friday weekly option. There's an AM settlement and a PM settlement. I've actually chosen to use the PM settlement. I laid a butterfly right at 2785. Okay, that's actually where the body of my butterfly happens to be. It's a really tight fly too. You know, we went out there, we paid what I think about between 20 and 25 cents for a $5 wide fly inside of the SPX with only 2 days remaining. But again, what happens if the marketplace doesn't pull back in? And again, you have to recognize that these butterflies are effectively lower probability trades. But if the marketplace doesn't necessarily pull back in there and we continue to fly, well, you lose 25 cents times however many contracts you do. It's $25 per fly. Not a half bad outside shot. Yet at the same time, you have a good probability that we do actually pull back in the next 2 days right into, again, in this neighborhood of like the 27 kind of 86. Again, I centered my fly right at 27.85. Now, with that, I'm going to cruise back over to some of the intraday trade, okay? Because the few things on the intraday basis that, you know, some things made sense, some things don't necessarily make sense, okay? So we know that the S&P has exploded higher, but it didn't matter what, okay, the market or news threw at this you know, thing today. Anything, okay? Anything goes today. Boeing. I'll start with Boeing over here and just pull this up for a second. So the news out of Boeing, which is, again, effectively the largest constituent inside of the Dow, right? The news out of Boeing, does it impact the broader markets? Not a whole lot, okay? Then, and again, let me go back to the S&Ps for a second. Then we actually get China news. What's the China news? They're not in such a rush, okay, for a trade deal. Does it impact the marketplace? Yes. All right. The S&Ps slipped, okay, mildly, before, of course, regaining every single ounce of that. We had Brexit news. You don't even see that on the tape, okay? The marketplace is all about correlation coefficients right now. It's all about correlation coefficients. What's that effectively mean? Means doesn't matter who you are, why you're there, they're buying you, okay? Look, this is the S&P 100. Again, it's the S&P 100. I don't look at the S&P 500 because you know what? 400 of those stocks simply don't matter. It's all about the S&P 100. You know, ironically, there's really only about 30 or 40 stocks that even have market cap enough to matter in the S&P 100. But in this particular case, you have, again, 95 products on one side of the advanced decline line. This doesn't have to do with individual stocks. This has to do with a hedging trade that is driving the futures higher. Okay, and we've actually driven ourselves to the point where, and you have to kind of gather this, you've driven yourself to the point where if we continue higher, traders have to turn around and they have to buy. Why do they have to buy? To hedge off any short deltas they may have. Okay, so we're caught right now, again, in kind of one of these little spirals higher. And this has happened time and again. This is nothing new. This is what we saw a tremendous amount, okay, during, of course, 2018. But there are some, odd things going on the screen today. One of those happened to be none other than the financials. Now, I pointed the bonds out a moment ago, but the financials, what are they? They're lagging on a percentage basis. The financials, okay, only up what? Oh, about 0.6%, with the S&Ps up about 0.7%, okay? Then I took a look over here at the monsters of tech. The monsters of tech are also lagging on a percentage basis. Those two alone, again, listen, those are some big sectors. Energy, though, energy was a really hot sector today, up about 1%. Those three sectors, though, they mean a tremendous amount. But put them aside for a second. One of the other strange things I saw on the screen, okay, is that actually net were a couple of buyers of some volatility today. The VVIX actually picked back up just a little bit. What I'm getting at over here is the S&Ps, everything kind of feels like fever pitch inside of the marketplace. Now, here's that broader take that I wanted to give you a moment ago when I said something in this marketplace has got to give. I'm going to bring up the spiders for a second, okay? And I think that the way to kind of delineate this is I'm going to use the spiders, and I just want you to for a second think about interest rates, okay? And or bonds. No, whichever does it for you. I'm going to take the spiders, which are, of course, the S&P 500, and I'm going to come over here and I'm going to go to studies, and I'm going to go add study, and I'm going to go compare with, custom symbol, and I'm going to type in TNX. Now, not everybody is necessarily familiar with TNX. TNX happens to be the 10-year, okay, treasury. It's the interest rate associated with it. I'm going to change from a candle to a line. And what I want to show you on this particular front, we're actually going to snap the time frame out a little bit more, maybe to 1 year. And we're going to go over here to go show price percentage, okay? What I wanted to show you over here when I say something has to kind of give in this particular circumstance is, first of all, here's interest rates, okay? The marketplace, and right back here in October, this is the S&Ps. The marketplace starts coming apart at the seams, okay, back in the time frame of late September, early October. And as the marketplace starts to fall, interest rates, they're fairly subtle initially, okay? But once the sell-side activity got strong inside of the S&Ps, interest rates kind of came rocketing down. Why? Because the interest rates were already getting ahead of the marketplace. The interest rates are saying like, listen, things are getting crazy. Things are getting crazy in the marketplace. Okay, we're going to back down the rates. They're not going to be that bad. Okay, effectively, what I'm saying is that, okay, the bond market had already priced in that the economy was starting to stall out. They took the interest rates back down. Now, okay, if you take a look at the present, have they rallied back up? This is where rates happen to be. Okay, this is the absolute bottom right over here. And that's the bottom, okay, of where the marketplace effectively bottomed out. It's also where interest rates bottomed out. We haven't moved. Okay, and again, I want to kind of delineate this in a number of different ways. We haven't really moved since, again, some of the bottom of those interest rates. Yet at the exact same time, the S&Ps have exploded back. All right, who's right and who's wrong? Because this is one of the largest divergences that we've seen, okay, any time in kind of recent history between, again, the S&Ps and, of course, the interest rates itself. Now, all right, one of two things. Okay, you have to understand the marketplace here, even though they're diverging, it's like the marketplace playing chicken. One of these is massively off. Okay, our interest rate's going to explode back up. I have a tough time believing that right now. Why? Because everything I hear is global slowdown, global slowdown. Okay, or does the equity market flip back around? Now, this is not being a case for bearish. This is a case for you understanding some of the risk of the divergence that exists right now between interest rates and effectively, okay, the S&P 500. So again, not trying to make a huge bearish case, but you have to recognize that in this scenario, we are at an absolute extreme, okay, and something has to give. And today is a prime, okay, example. And I'm actually going to snap back to the bonds. The bonds, okay, were in effect dead today. They didn't do anything. The bonds nor the notes in a day where the S&Ps decided once again to explode up 21. One last thing I want to kind of reiterate on that particular front. Volumes, okay, net are non-existent right now on an intraday basis. Now, you can look at a lot in terms of volume, but you start to look at equity volume, they're non-existent. Now, the S&P futures volume, it happens to be elevated because there is a roll going on inside of the S&P futures. Nevertheless, if you take a look, okay, at net volumes in the marketplace, you have a day, today specifically, where the S&Ps went up 22 with, absolutely unequivocally, some of the lightest volume that we've seen, again, in kind of recent history. One last thing that I want to leave you with this evening on this video, and that happens to be dividends are coming in major ETF products. Now, I'm going to talk about this in much more detail tomorrow morning live on TheoTrade, okay? But there's some critical things that you need to know as a trader about the dividends in the ETFs. Now, for those of you that do trade options, okay? If you do trade options, I'm going to go ahead and I'm going to open up the March, okay, options. These are the March 15th expiration. These are the Friday expiration options, okay? When I say that there are dividends coming, the dividends that I'm concerned with, again, are major ETF products. Now, I can name just a few off the top of my head, but this would not be limited. It would be the spiders, okay? IWM, the QQQ. I mean, we can go on for a half an hour of all the different major dividend products, okay? They're going to have dividends that are coming out. Again, the ex-dividend date is this Friday, which leaves you as a trader, if you have short calls that are in the money, it could leave you with dividend risk. A few points, though, that I want to make with this, okay? First and foremost, if you're trading puts, the puts themselves do not, okay, do not have dividend risk. So if you're using strategies like what we call risk twist spreads, you're fine. You're fine with risk twist spreads. What strategies, okay, may you have on in something like the spiders, though? Well, maybe I went out there and I sold, okay, a call spread. If I sold a call spread and the legs of that call spread are now in the money. When I say in the money, okay, this is the shaded region on my screen. If those, okay, calls that you're short are in the money, there is a high likelihood of them being assigned. If you're assigned on a short call, you end up what? Short, okay, stock. If you're short stock, let's say you're, minus 100 shares of stock, the short stock ends up paying the dividend. Now, okay, a lot of people, they'll forget about trades. They'll leave trades on a little bit too long. When's the last time that you can get out, okay, without necessarily getting assigned? Thursday. That's this Thursday. That's tomorrow, okay? March 14th. You have to be able to go ahead and close out of these positions. In this particular case, I'm actually showing you a leftover trade that I had, okay, from months ago. Rolled it a couple times, did a little dance, made a little love, still got run over. And that's okay. Like, this happens when you're building an inventory, but this is a spread I have to close. Why? Because these short 264 calls, okay, are assured to be assigned. Now I'm going to give you another one too. I've actually got another leftover position. These are all the way out, 16 days into the future. 16 days out, because a lot of people, they don't realize what their dividend risk happens to be. Okay. And these are 269 calls. They're not massively deep in the money. But if I don't close this position, I will be assigned, okay, short stock, and I will end up paying the dividend. If you have questions about that, okay, tune in tomorrow morning. Again, tomorrow morning, it's Thursday, right at the cash open. I'll be on for the first hour, okay, discussing more about the specifics and the tactics, if you will, about these dividends surrounding ETFs. With that, thank you very much for joining us here at TheoTrade. Have a wonderful evening. Bye-bye.